Thank you all for coming. My name is Bruce Pittman. I'm Dean of the College of Arts and Sciences, and I'd like to welcome you to this conversation about the economy, featuring one of the college's great alums, Bill Strauss. This morning's program is sponsored by the college and UB's Office of Gift Planning, and we'll hear a little bit from Wendy Irving later on from the Office of Gift Planning. It's great for me to introduce Bill Strauss. Bill is a 1980 graduate of the College of Arts and Sciences in economics and geography. He then went to my alma mater, actually, Northwestern, and earned a master's degree in economics, and from there started with the Chicago Fed. And he's been down at the Chicago Fed ever since. He does some research and analysis on manufacturing sector. Try that one too early in the morning. Automotive, the Midwest regional economy, Federal Reserve payment options. You may have seen Bill's being quoted in various business magazines or newspapers, heard him on public radio, seen him on TV. He's a go-to guy for many of the media outlets when they want expert opinions about things that are happening in the economy. Bill is also a member of the Dean's Advisory Council, so a group of alums and benefactors who are able to talk with me, I'm able to turn to for opinions and advice. He's been giving back to the college in so many ways of his times and talent. And I'm very grateful to him for all that he does. Without delaying this any further, I'd like us to all welcome Bill Strauss for his conversation about the economy. Bill?
All right, thank you, Bruce, and good morning, everybody. So, conversation about the economy. We're going to certainly try to do it as a conversation. I've got some prepared material, not too many slides all in all, but at the same time, we'll cover those, and then that'll leave time for questions and answers. And in fact, given the relatively nice-sized audience we have, if we have a question during the presentation, you can raise your hand and I can recognize you. We'll try to do it more of a seminar rather than as a lecture during the presentation. But again, it's my pleasure to join you. As Bruce mentioned, I started at the Fed back in 1982. Thought it would be a good place to start, a good stepping stone to something else, and I found it just a fascinating environment to be in. It's probably outside of academia, as close to academia as you can come, and still be in the relatively quasi-public, quasi-private sector. So what I want to do is talk about how the economy is doing, and this is part of our kickoff, or it's been going on, I guess, for a short while. The College of Arts and Sciences 100th anniversary, and that's certainly a great accomplishment, great school. In addition, it's also the Fed's 100th anniversary. We were established by an act of Congress back in 1913. So we have that in common. So how is the economy doing? Well, it's a story of good news and bad news. So let me give you the good news first. When you look around the world and you realize some of the challenges that are taking place, Europe had been in a recession. I spent a couple of weeks in Europe in September, and after presenting to them, all in all, a very so-so outlook, which is what I'm going to give you, so-so outlook. The first question I got out of the Zurich Chamber of Commerce was, why are Americans always so optimistic? And it wasn't that, I didn't think I was that optimistic. I think all in all, I was very concerned and moderate in terms of the outlook. But relative to what they're experiencing, it is optimistic. So it's all relative. So they're emerging out of this recession, but the growth is not great, nor is it expected to be very good. In fact, the European Central Bank just last week lowered interest rates by 25 basis points. Why? They're very concerned that their price increases for inflation path is a lot weaker. In other words, they're getting a little nervous about deflation in their economy. And that's what happens when your economy is not growing very rapidly. And I'll talk more about that towards the end. You look around at in Asia, growth out there is also being challenged. High growth rates, say in China all in all, but relative to what they had been, double-digit growth, they're now expecting to come in at about 7.5% or so, both now as well as for the next several years. So their growth path is slowing. Japan is trying very hard to stimulate their economy. They've had some success on the inflation front, not so much on the growth front yet. But so I guess the good news is that when you do look around the world, it appears that the U.S. economy is the strongest economy in the world. I'll give you the bad news. The U.S. economy appears to be the strongest economy in the world because the kind of growth rates that we are talking about are all in all not very impressive. Now you have that very famous quote from Benjamin Disraeli, the British Prime Minister from the 1800s, who said that there are three types of lies. You have your lies, then you have damn lies, and then you have the worst type of lie, statistics. And that's this, observed well over 100 years ago, true today as it was back then. You can easily mislead the people by just kind of showing only one side of the story or using statistics in such a way as to be very misleading. That, by the way, is one of the joys I have at working at the Fed is that we don't have a political agenda. We're not trying to get reelected. We're trying to do an honest assessment of how the economy is performing. So when you look at the numbers, I can turn around and say, look, U.S. economy has been growing now for 17 quarters, basically, since the middle of 2009, more than 4 years of growth. GDP in this country has never been higher. All true. What the question is, what's the proper metric? Is zero the proper growth rate for our economy, and we should celebrate the fact that we're had growth that is above zero? Absolutely not. Economies grow for basically two basic factors. First factor is labor force growth, population growth, ultimately hours worked. But labor force growth in the U.S. is just under 1%, which means each and every year with 1% more people contributing to the output of the economy, the economic pie increases by 1%. But keep in mind, while you have a 1% larger economy, you have 1% more people wanting their slice of that economy. So on average, your living standards remain unchanged. This is something that China learned about off of work by economists who talked about the fact that fast population growth tends to really limit the improvements on living standards. And that's, China went so far as to have the draconian policy of one child per household, which has now set them up for population declines shortly. In fact, their population growth right now is at 0.5%, half of what it is in the U.S. India, which is just behind China in population, although it's hard to say, they don't do a very good job of coming up with census numbers, but India's growth rate on population is about 1.3%. So in the next several years, India, in fact, will be the most populous country in the world. But as highlighted, China recognized that, if we're going to try to grow our economy and improve living standards, we need to control the labor force growth and population growth. So holding population constant, what's the other way that you can grow an economy? Well, simply doing things smarter, more effectively, more efficiently. What do we call productivity? Productivity could be adding more machines, adding better machines, adding better workers, part of what the university is all about. is trying to educate the workforce for the skills that are going to be needed to be able to have an effective economy. So that we call human capital. So all of those things, you can kind of sum them up, and it appears that in the United States, that's about 1 to 1.25%. What that means is holding everything else constant, our economy can expand by 1 to 1.25% each and every year without adding labor, which means each individual slice of that pie, on average, can rise. And that's why we've witnessed in the growth of our economy in the United States an improvement on living standards over time, directly linked to productivity, doing things more efficiently. Now you can add those two growth rates together, the 1% labor force growth, the 1 to 1.25% productivity growth, and you come up with what we think of as trend growth for the US economy of 2 to 2.25%. And now you can see, how growth over the past year, we have third quarter GDP up there, came in at 2.8%, that last bar, but on a year-over-year basis, we're still sitting at growth of just 1.6%. This is well below that trend. So, am I happy that we are higher than we were a year ago? Sure. But I'm also very disappointed because we could have done better. And in fact, I'm very disappointed with the last 4 years, considering the Great Recession that we went through. Now, we call it the Great Recession, that gray shaded area where we saw all of those downturns between basically peaking in December of 07, troughing in June of 09, where we saw output in our economy fall by over 4%. This was both the deepest drop in economic activity as well as the longest lived downturn since the 1930s, the Great Depression. So since this was a worse recession than anything that we had seen since the 1930s, it's been dubbed the Great Recession. But why is it different this time? Why are we not getting this more significant bounce back? Oftentimes, yes, sir.
Just a quick question. What was the past trend growth from, say, World War II?
Great question. So trend growth in the past was actually a bit higher. For example, when I started work in the 1980s, we thought trend growth in the U.S. was around 3%. In part, a little bit better productivity growth. We were starting the whole capital revolution, especially with computer numerical controls on machines and that whole computer revolution. So we had that going from us from a low base. Second thing is we had greater participation by women. Right, women's participation in the labor force began increasing in the 1960s, and then leveled out in the mid-1990s. So as they participated more, we had a little faster labor force growth. And then, of course, the baby boom generation that came into the workforce. I started my work in 1982, right? So I was one of those that was adding to that. So both for population growth, labor force growth, as well as productivity, it was a bit faster than we have today. But that's not unusual. I mean, in part, China growing at double digit could not be sustained. It gets harder and harder to grow a larger and larger economy because it's hard to find those things that will really boost you up significantly. One of the reasons why I'll talk a little bit about energy, I think the energy play that we're experiencing now is going to be beneficial for our economy, but all in all, is not going to move the needle significantly on the size of our GDP growth, just because how large of our economy is relative to that energy sector. And we'll talk more about that. But normally we think that the recovery period, expansion period, actually I could define that. The recovery period, after you fall, you're at a certain peak level, you go down, that's the downturn, the recession, go down deep enough, a depression, and then you begin to grow again. That's called the recovery period. And you're in the recovery period until you reach your previous peak. So we recovered that 4.4% loss of output several years ago. So now we actually have this record high GDP. So technically we're in the expansion phase of our business cycle. Semantics. Point is, the growth that we've been experiencing all in all has been not the greatest. It's been so-so. And I'll give another example in a short while. But like the 1930s, this downturn was associated with a financial crisis. And what you find is that both downturns tend to be deeper and recoveries tend to be more muted when you have a financial crisis that is basically slowing or impacting your economy. Now you can see the financial crisis and the aftermath with this chart here. Here's the Fed's liability. So this is the Fed balance sheet. I'll show you assets at the end when I want to talk about monetary policy. But before the financial crisis, you could see that this early stage here, it was mainly just the currency in circulation. All those greenbacks you have in your wallets and purses, those that say, Federal Reserve notes. So that's what we owe the American people to make good on that. In addition, as many of you are aware, every time you make a deposit at a financial institution, they're required to set aside a certain portion of that, known as the required reserve. Now, a bank can hold more than that. There's nothing to say they can't hold money beyond what they're required to hold according to law. But historically, that's not how banks made their money. They made their money by paying a depositor an interest rate down here and charging a borrower an interest rate up here. And then on a risk-adjusted basis, that's how banks made their money. So they tend to hold very little excess reserves. So this tiny sliver of red that even on this slide here you can hardly see, that's what the required reserves. Now come into that post-fall of 2008 and you can see the explosion of red. Now the required reserve should still be a tiny sliver here that you should hardly be able to discern on that chart. So all of that extra amount of red are all the excess reserves that these financial institutions are holding. Now, why are they acting differently? Well, for both supply as well as demand factors. Think about the supply factor. One of the key issues that brought us into this whole thing was the housing bubble. We basically had too many homes brought onto the market. Too many people that bought homes that should not have. We had a pricing frenzy that brought prices up to unsustainable levels. And we've seen a correction. And during that correction, we saw home prices plummet. And so we saw foreclosures rise, distress galore. You think that in a market where prices are going down, foreclosures are rising, if a developer came into a financial institution during this period and said, I got a plot of land out here, I'd like to put up 200 homes, that banker would be willing to make that loan? Probably not. You might not believe it, but most bankers actually want to get the money back when they make that loan. So because of the risk associated with the excesses that are out there, what we call slack in the economy, there was hesitancy to make loans in the residential area. Commercial real estate, similar issue. Certainly, look at your strip malls around town. I'm sure you still see plenty of vacancies, even 4 years after the recovery has begun. You go to your malls, right? Malls, you can't find a mall that doesn't have some open space for a store to move in. So you can't imagine that until that occupancy rate improves, there's going to be willingness to add more capacity into those sectors. On the demand front, this economy, while expanding, is not taking off like a skyrocket. Businesses do not feel like, if I don't expand, if I don't add more machinery, if I don't hire more people, I'm going to lose business because my competitor is going to take that away. The kind of growth we're experiencing is the kind of growth that is just, so-so, and productivity, to a large degree, is taking care of much of that. And profits are doing well, right? Look at the stock market. Companies are doing well in profits. Many of them are just using those profits to internally finance whatever limited amount of investment they're doing. So there hasn't been this great need to go into the markets to borrow. So we have this large amount of excess reserves that reside out there. But this is a positive because the pendulum is swinging. Markets are clearing. Price mechanisms are having some impact on that. And as we are seeing a greater willingness to lend, greater willingness to borrow, the financial institutions have the assets on their books to lend. It's not like they're going to have to go out and try to attract more capital to make those loans. So that is a positive. I mentioned about the housing market, You can see that old adage, you always, you hear from real estate agents for decades on that, homes are a great investment. Homes only go up in value, they never fall. Well, they weren't misleading because the history since World War II was just that. Home prices, at least in nominal terms, always went higher. Kind of just kept marching higher and higher and higher, except for the bubble that got built up. And in particular, during that 2003 to 2005 period, which sent prices up quite significantly, and we have seen a major correction. Nationally, prices fell by a third. This was a huge hit. Of course, in certain markets, Nevada, Arizona, Florida, California, we saw much deeper drops in excess of 50% on home values. And this was a big impact on consumers. 2/3 of American households own their own home. This was a huge wealth hit. Whether you had a home with a mortgage or whether you owned it free and clear, if your neighbor's prices were falling, your prices fell as well. So there was a huge wealth loss, and people felt poorer. And this affected people's willingness to go out and buy things, invest in their homes, to, add on and so forth. So we're seeing a real restraint on that. The good news is that prices are beginning to move higher. And price growth actually has been, depending on what measurement you want to use, FHFA, the Federal Housing Finance Agency, has it about 8% gain. The National Association of Realtor data here is about 12% gain on a year-over-year basis. So they're actually bouncing back quite significantly. And people are worried, could it be a bubble? I'm not so sure it is. When you look at this as a nominal indicator, so you'd have to go back to like 2005 to see a similar price. But keep in mind, that was 8 years ago. So, pick your inflation rate. Let's keep it simple. Let's say 1%. It's been a little bit faster than that, but let's say 1%, which says that take today's number and knock it down by at least 8% to put it in real terms. In addition, there is still distress in the housing market. 15 to 20% of mortgages out there are still underwater. So every percentage point that home values move higher, fewer and fewer households are finding themselves in a position of owing more than the home is actually worth. So this market is still, all in all, in a recovery phase. And the new inventory of homes, so that's what housing starts, that's what they do. They add more to the existing stock of homes. This new additional amount of housing is increasing, but increasing, all in all, very slowly. Why do you build homes? To live in, for people. 1% population growth, 1% new household formation, that should generate a little over 1 million new households a year. Add to that the number of homes that just wear out, they age, they need to be torn down. The homes that get destroyed by fires, floods, and other natural disasters. It's about 300,000, 400,000 there. So add those two together, and you come up with about 1.4 million as what we typically should be doing. And you can see that both this year and next year is operating well below that. I should point out this Blue Chip. Blue Chip is this organization that collects forecasts from roughly 50 different individuals, businesses, individuals, economists, and this is the midpoint, the kind of median consensus value for what they think is going to happen. And what you can see is that next year, a little over 1.1 million. So again, adding more than we did this past year, but still well below this trend. Part of the problem is that household formation has been very, very low. We have kids who are graduating from college that in the past might have gone out and gotten their own place. Not necessarily to purchase, because when we talk about household formation and housing stock, this includes also for rental units. It's multifamily and single family. That's not happening. These college kids, many of them are now going home to live with mom and dad. right? Or if they're going out to get an apartment, they're no longer going out and getting their own place. They're doing it with 2, 3 other individuals. And so the question is our society becoming the Three's Company? Those younger college students might not know what I'm talking about. All right, or the Odd Couple, you know, where you get these 2 older guys living together, the Felix and Oscars, so our kids going to live with their parents until they're like 50 years old. I know I'm scaring some of you parents out there. You know, I'm not ready to commit that. But if that's not the case, that they're not, in other words, they're not going to stay there forever, that represents pent-up demand for housing units. So there's probably about 750,000 to close to 1 million new households that have not been formed. What's going to spring that? What's going to unleash that? In my opinion, a better labor market, a better wage for individuals, and a greater sense of improvement on their earnings. Well, that's related to all of that. So the thing is about the people are delaying activity. They're having children later. In fact, there's I hate to point out another university. There's a wonderful report that Georgetown University put out about 2 weeks ago, entitled "Failure to Launch." And it's written like a consultant report, so it's got a lot of pictures and a lot of white space on the page. It's about 80 pages. I read it in a short flight on the plane, but it talks about those issues that you're raising. It's big concerns.
Well, what I wondered was, how does the model address that? Because in the post-World War II era, you had people marrying, after the war ended, young, and that trend stayed.
Mm-hmm.
It looks like this is a pattern. So how does the model address that?
What model? You're the model. What do you think? What do you think's going to happen?
They're not getting married.
I know, but how would that impact the outlook?
Well, I would think then everything will be pushed out further.
So you would think population, they're going to probably have fewer kids. If you start later, you might have fewer kids. So you could be looking at population growth that is going to slow. Those are being built into the view of where the economy is going. The fact that, I think, if I remember correctly, the study suggested that in the past you would reach the midpoint earning level at the age of 26. It is now, I think, either 29 or 30. So having less earning, and that's the issue about having a better labor market, would encourage people to take that risk and go out on their own more quickly. I think that, again, is impacting and delaying activity. Absolutely.
I'm wondering how does the increase in terms of our population's aging and the needs of the aging population in terms of different kinds of homes and facilities, will that help to balance this out?
That's a great question. So the question is, how is the aging of our population going to be impacting the type of homes? Is the housing stock that we have in place sufficient for older people? In other words, if you've got these, 2- and 3-story units, townhomes, things like that, how effective is that going to be for somebody who has trouble negotiating stairs? That's a great question, and I think that you're going to see some market reaction out of that. And the question is, whether or not you're going to see different pricing, that those units that are going to be for the retired or older workers, they're not going to be retired, but the older individuals could be in greater demand, and that might be what needs to be built at this point, and leave the vintage stock for entry-level homeowners. Another great factor with regard, so we're seeing home values move up, and that's been very helpful, where people are not thinking that their major asset is losing value. It's now, in fact, starting to gain value. Equity markets are also have moved up. This, too, is a nominal indicator, so once again, you need to kind of adjust that for inflation. But nonetheless, when people look at their 401k, retirement balance sheets, they're feeling, again, a bit wealthier and are willing to take greater risk. So what is the outlook according to Blue Chip? So Blue Chip sees that after seeing the economy grow at 2% last year, so right around the bottom end of trend, they're believing that this year it will come in again at about 2%. Next year, about 2.8%. So next year's growth is expected to show improvement, in fact, grow above trend. Problem is, it's not substantially above trend. It's just somewhat above trend, moderately above trend. It's definitely going to feel better. The economy is going to be accelerating in terms of its growth path, according to this forecast. But it's not, again, great. I'll show you what great would be like. So what is the Fed thinking? Well, at the September FOMC, the Federal Open Market Committee, the 19 policymakers who sit on that committee, 7 governors, 12 Reserve Bank presidents, submit forecasts. In fact, right now, this only has 17 of those individuals. 2 of the governors, we're missing 1 governor. There's a vacancy there, and another governor who has been put up for appointment for the Treasury has excused herself from participating at the FOMC. So we have 17 forecasts here. So what are they thinking? Well, actually, not too dissimilar from blue chip. They're seeing growth that is around 2% this year, and then around 3% next year. So 3% versus 2.8, same number. It's an economy which is growing just about a percentage point or so away from its trend. And we go out a bit further than blue chip because of the lags in monetary policy. We have to be outwardly looking much further than just a year. So we have the 2015 forecast on there where it moves up to 3.25%, so a tick higher than what we're thinking for next year. And then for the first time, we're offering up a view for 2016. Now, this is 3 years out, a lot can happen. But I found it interesting when this number came out, the very fact that it ticked back down. Because there are people who talk about, do we have this pent-up demand on housing that if we can just unleash it, can really get us sustained up to a much better growth path? Are we due for a 4%, 5% year if we just get past all of this in nonsense, all these imbalances and the government this and that, we can really soar ahead. The very fact that it ticked down, to me, suggested as a potential that this might be saying, maybe this is as good as it gets. Maybe this pent-up demand gets sated by this 1% above trend growth for a couple of years. That would be, to me, all in all, very disappointing. Let me show you why this recovery has been so disappointing. So here we have the 2 previous deep downturns for the U.S. economy. Many of you will remember this, the mid-'70s and the early 1980s. What I've done, and those are illustrated in this brown line here and the red line, what I've done is I've indexed the bottom quarter of GDP, the lowest quarter of GDP for each of those cycles. And I said that's the trough quarter, 0. This is 8 quarters before the recession, so you can kind of see the drop off. The fact that the current cycle in blue fell further is because of that 4.4%. It was a bigger drop than any of the others. But then we go out 17 quarters. That would bring us up to the 3rd quarter of this year for the current cycle. What you could see is for both the early 80s and the mid 70s, our economy in just a little over 4 years increased by more than a fifth. So we were more than 20% larger as an economy within a 4-year or just over 4-year period. What does that translate into? It translates into a growth rate of 5% and 4.7% respectively for those 2 cycles. Now, what was trend back then? Well, as already mentioned, 3% is what we thought trend was. So what this says is that, we didn't exceed trend by 1% for a couple of years. We exceeded trend by anywhere from 1.7% to 2% higher for over 4 years. That is how you materially remove slack out of the economy. Now, again, I can tell you, look at that. We're higher than ever before. Our economy is 10% higher than the middle of 2009, which would be great, again, if the trend rate was 0, but it's not. In fact, what does this average out to? 2.3%. So after falling by more than 4%, all we've managed to do is match what we are capable of doing. That says that we should still have tremendous slack. Because what we're capable of doing has continued, right? We didn't stop the aging process, right? Everybody here is 4 years older than you were in the middle of 2009, right? And Buffalo's going to graduate more students this year. We need to have jobs for them. So labor force has continued at 1%. Businesses have not stopped thinking about how to be more effective at what they do. Productivity has continued each and every year. So we still, after falling, have just matched, we should have tremendous slack. And I don't think you need to look any further than the labor markets to see that. Now, again, I can tell you all about the fact that, we've added over 7.2 million workers, 44 months of gains on employment. Isn't that great? It is, but it's not being honest if we ignore the fact that during the downturn, we lost 8.7 million workers. So we are still short of where we are from the December of 2007 level, let alone the fact that, but we've been adding 2.3 million over the past year. That's a nice growth rate, which says, and if the economy accelerates, it will continue, if not do a bit better, that sometime in the spring, we will finally recover the remaining lost number of jobs, which will mean that sometime early next year, in the spring probably, we will be at a new record high for employment in the United States. And Washington will celebrate, people will celebrate, talking all about, we have more people working in this country than ever before. I might have a nice shot of some drink to drown my sorrows, because what I'm going to recognize and remember is the fact that since 2007, each and every year, we've added about 1 million workers to our workforce that are still looking for a job. So we're going to still have tremendous slack, even though we will have more people working in this country next year, to the tune of around 6-7 million.
The consensus is that those are low-level jobs. What's your opinion?
Are they low level or high level? The answer is yes. Both jobs are being created. Well, let me talk about some of the challenges with regard to the labor market in addition to that in just a second. Yes, sir.
Regarding the Fed's employment mandate, can you comment at all why they use the unemployment rate as a target rather than participation rate?
Yeah, you think a participation rate would be a better measurement? So first of all, the Fed has two goals. It's actually not labor markets. It's to have it's basically to have inflation under control, and it's to have a sustained growth for the U.S. economy, full employment if you want. But the unemployment rate is really being used as kind of a gauge. And in fact, our president of the Chicago Fed, Charles Evans, was the one that was suggesting that we have this that we should not think about removing much accommodation until we get down to around 6.5%. Now the question is the unemployment rate a great measurement? And the answer is not really. There's all kinds of issues with it, and I'll talk about those in just a minute. However, the belief would be that the unemployment rate would be hard pressed to fall to 6.5% without the labor markets really improving. But I'll talk more about the unemployment rate in just a second. Yes, ma'am.
Yeah, I was wondering if you wanted to take into consideration this book by Jim Clifton, The Gallup Poll. That was the first time that we've had a really complete jobs report for the whole world. He makes the point that we need 3 billion full-time jobs worldwide. And worldwide, there are only 1.2 billion full-paying jobs. And so no matter how we want to look at it, there's going to be a shortfall of 1.8 billion jobs worldwide.
Well, I think this is getting back to the good jobs, bad jobs thing, because in fact there are shortages that exist right now. Skilled workers. In fact, part of my reason for visiting Europe was I was invited by the Austrian government back in September to participate in this thing to look at their workforce development for the dual track system, in particular for manufacturing workers. But even as much as, so they have it where it's a young person at the age of 15 has to make a decision. Are you going to go to college? If you're going to go to college, you continue doing school like we do here in the United States, going to classes 5 days a week. If you're thinking college isn't in your future, well, then you start being associated with a business to learn, and you become an apprentice to learn how that business operates, learn the skills of that industry. Yet, with the companies that we visited, I asked the last question. Most of the people there were actually workforce development people, whether from National Association of Manufacturers or Association of Manufacturing Technology, community college person. And they were all enamored by this, this whole program, and it's impressive. But ultimately, from my standpoint, it's a matter of, are you meeting the needs of the market? And at each of the companies that we visited, some very impressive companies, my answer, or my question was to each and every one of them was, do you have any trouble filling any of your jobs? Everyone said the same thing. Absolutely. Engineers, high-skilled workers, welders, all the stuff that when you talk to American businesses, you hear the exact same thing. So at the very end of our conclusion, I mean, I know I didn't want to be rude to our hosts over there, but as we're doing our summary, everybody's praising how great their, the model is and how, what things we could learn about it, and there's certainly things we could learn. But I pointed this out. I said, ultimately, it's a question of whether we transplanted that kind of a process into the U.S. Will that solve our problem? Doubtful. It's not solving their problem. They have to try to figure out how to get, people from the Czech Republic to come in to work, and there's language issues, and they don't want to be away from their families, and, So my point is, there are skills issues, but the problem is that we need to be making sure that we develop our young people to be able to do the jobs of the future. Now, what does that mean? Well, I think the simple way of responding to this is that we are becoming ever increasingly a knowledge-based economy, which means that to be successful, you need to have some knowledge. The number of unskilled positions that are out there are disappearing. I use the supermarket as just one example. It's something that we all witness over our lifetime, how technology has really changed the way that business operates. You go back 30 years ago, and you had people in there who would have to price all the goods with little machines that would put price stickers on there. And especially during an inflationary period, there was a lot of work to do because they'd have to put prices over the old prices and keep that going. Then we added barcode scanning, and that made that no longer necessary. You could just put prices on you didn't have to price every can. You could just put prices on the shelf. Then we figured out, well, if we don't have to close for inventory anymore. Remember how they used to close stores for inventory and have all their staff run around, count up all the boxes of macaroni and cheese to find out how many more we needed to order? You didn't need to do that because now when you knew what you brought in, your computers were keeping track of what was being sold. The difference was how much inventory you had left. So you had automated inventory process. So you didn't need to hire workers to do that job. And of course, then you had the ordering. You used to have people who actually placed the order. Now you tie in systems that allow that to take place. Now the next phase of that is going to be RFID, radio frequency identification. And once you start putting those little chips on the packages, now you'll just have to have a scanner that you go through. So you could eliminate the checkout person to a degree. And already some of the stores are doing that, right, where you can check yourself out, trying to have somebody monitor 6 or 7 cash registers rather than just doing one. So all of these are basically labor displacing, making us more efficient, yes, but ultimately displacing. And what skills are the easiest to replace by technology? The easiest ones are the low skilled. But even in the high tech, we're seeing a lot of improvement there when you think about the whole medical industry. Sir?
With the low interest rates, historically, they think inflation was high. But yet we know inflation has been very low. And I understand that maybe because of the international competition of companies, they want to keep their
Well, the low interest rates are there because the Fed is basically doing it. It's
high.
sorry?
Now it's not high. Inflation is still very low. Too.
Well, but if inflation was high, you actually would have higher interest rates because nominal interest rates are both your real interest rate plus the rate of inflation. So if a very fact that inflation is at 1%, that wouldn't be adding much to
My understanding from my course was wage increases is the underlying rate of inflation.
It's one of the factors, sure.
So could you comment a little bit on the idea of profit sharing, instead of the union continue trying to increase wages?
Well, I mean, I think, so profit, I mean, I think that's one of the objectives that is happening you mentioned the union side. That's certainly one of the, I like to, so when I teach my students, one of the things I like to share with them, I teach both at DePaul University and the University of Chicago. One of the things I like to share with them is that basically economics is all about incentives. And so what profit sharing does is basically give incentives to the worker to understand that my compensation, bonuses and so forth, will depend upon how effectively my company is doing. Of course, because you ultimately, and not only you, but your coworker, if they're slacking off, messing up product, wasteful this, it's costing you out of your own pocket to a degree. So there's reasons not to want to, slough off of what you're doing, to put a little bit more effort in. I think that's part of the goal there. But I agree with you that wages are, again, key to all of this. But again, what's happening with wages? Not much activity outside of these areas where there are shortages, and that's in part because of all the slack. I mean, as mentioned, we have this large pool of unemployed workers. We'll talk about unemployment in just a second. Yes, one more question, we'll move on.
What's your view on nationally raising minimum wage to have a strong impact on positively economic growth?
So, I mean, there's a lot of mixed results with regard to how impactful raising minimum wages are. In general, my view is they do more harm than good. And that actually goes against some of the work that the Chicago Fed labor economists have come out with. But I think part of what I have an issue with is that when you have unemployment, and of course the group that has been most dearly impacted during this downturn has been the least skilled among us. And that, in fact, turns out to be the young workers. And to make them more expensive to hire, you wind up hiring fewer of those. And I think the opportunity of getting the skills that work will provide to you, if you don't get those when you're young, the question is, will you lose the ability of engaging them into the future? So I would be very much opposed to that. The issue is, you can't live on the kind of wages you get there. Well, there are a lot of other ways that you can address that. First of all, the vast majority of people earning minimum wage are not earning it as a single sole income to provide for a family. But for those individuals who are, you could have better policies, whether it's some kind of a tax credit, negative income tax policy that would basically, give a subsidy there. It should not be borne on the market as a whole, because a large part of the unemployed the minimum wage workers are those young kids who are working part-time, and they would be learning skills. So to raise it up, I think, would be very hurtful. It already is, as where it is right now, hurtful to that. In fact, they talk about every percentage percentage point in wages winds up adding about 3 percentage points of additional unemployment in that ratio, 1 to 3. So let's talk about the unemployment rate. So the unemployment rate remaining very high at 7.3%. This is a high number. Plain and simple. It's come down, yes, but when you look at it from a historical perspective, it's still very high. And this is what's called the U3. Now, there are a total of 6 different measurements of the unemployment. The ones that are higher adds a number of different categories. First of all, you got the issue about discouraged worker. In order to be counted as unemployed, you must be actively seeking work. And discouraged worker phenomena, those who basically have said, I would love to get a job, but I'm just tired of looking. It seems to be, not very helpful. I'm just wearing out the bottom of my shoes searching for that job. So you would say that person is unemployed, but unless you're actively looking for work, you are not counted as part of the U3 official measurement. That adds about 0.5% to this measurement, the discouraged worker phenomena. That is slightly higher than historically, right? Because there's always people that are discouraged, either they don't have the right job skill match and so forth. So it's a little bit higher, but not incredibly higher historically. There's also another position of those that are marginally attached to the labor force. These are people who could work, but for different factors, some of which is, taking care of a sick relative, those students who are going to school, right? These young people could get a job, but they've got other things right now stopping them from doing that. That adds about a percentage point to our unemployment, to the unemployment rate. That would bring us up to U5. And that also hasn't risen all that much relative to historical. It's up, but just only a little bit. The one that has really changed the most has been, and now we're getting back to that issue about full-time work, those people who are working part-time for economic reasons. That brings us up to the U6 measurement. That adds 5 percentage points. What does that mean, working part-time for economic reasons? It means individuals who would like to work full-time but cannot find a full-time job. That is up about 2 percentage points off of historical measurements. And that is a big impact. That's affecting people's wages and income. The fact that they're finding it hard to find a full-time job, that then might give them the benefits on top of that, let alone the hours needed to have a decent income. So the point is, when you could add all those other factors, you're well in excess of 13%, approaching 14% with your unemployment. So again, all in all, a very, very slack market. So what's expected? Well, with improvement on the growth of the economy, but only a little bit above trend, because trend growth should have you little changed on your unemployment rate. So a little bit above trend, we're seeing the unemployment rate, according to Blue Chip, fall from 7.3% now down to 6.8% by the end of next year. A 0.5% improvement over the next year. This is still very high. Most people think that the natural rate is somewhere between 5.25% to maybe 6% or 5.75%. So this is all in all very high. The Fed sees a very similar kind of pattern. They're expecting this quarter, the last quarter, to come in a little over 7%. End of next year, around 6.5% or so. 2 years from now, a number that is still just above 6%. And then finally, by 2016, 3 years from now, seeing a number that gets close to the natural rate. Although the Chicago Fed view would be a natural rate that is closer to this 5.2% rate as compared to the 5.6% rate that we're going to be at. So our view would be you'd actually going to have to wait till 2017. So that's why I'm not going to celebrate next year when we have more people employed in this country than ever before, because I realize that we have still about 3 years to go before we are back to a more normalized position. So let's talk about inflation, because you hear a lot of people talking about the fact that, the Fed is printing money like it's going out of style. Banks all around the world are printing money like it's going out of style. That's going to be inflationary. Well, the story I've been telling you today is one of slack, one of too much. So when your shelves have too many goods on it, if you're a retailer, do you mark the prices up to clear those shelves? No, the price goes down. When your labor markets have too many unemployed, is that a time when you see rising wages? No, the exact opposite. You see wages that tend to be cut because you've got unemployed who want your job and they're willing to do it for less than what you're getting paid because they need a job. So employers know that, employees know that. So there tends to be less wage pressure that tends to happen. And by the way, for those of you who have kept your jobs throughout this horrible economic period we've gone through, that is part of the price that you have paid as well. Because if we had a more normalized labor market, your real wages would be higher today, in my view, than where they are today on average. So in this period of slack, this should be not a time period where we talk about rising prices. It should be one of weakening prices. And in fact, on the measurement that the Fed tends to follow, the Personal Consumption Expenditure Price Index, the most recent reading, which we received on Friday, showed a number that is now actually below 1% on a year-over-year basis. We had Chairman Bernanke at the bank when we had this number come in, and I asked the chairman, how concerned he was with regard to deflation, because it's moving lower. And he talked about the fact that there were some special factors in the springtime that kind of drove it down, and that we would probably bounce back up, and sure enough, it did. But now we're past those special factors, and those numbers are beginning to move lower again. And I am nervous. I am nervous with regard to the weakness. And then you add on again what's happening in Europe, that also makes me nervous. But of course, those numbers include food and energy prices. It includes everything. Energy prices are high, although those have pulled back of late, but still from a historical perspective, and this is in real terms, remaining very high. And you can see how during the last recession, it skyrocketed up to significant levels. In fact, on a daily rate, it had $147 a barrel in July of 2008. 6 months later, in January of 2009, during the deepest part of the downturn of the recession, it fell to $33 a barrel. Could you imagine? You're there, you were there. $147 a barrel to $33 in 6 months. That's how the kind of depression mentality that people were operating under. It's moved back up, as you can see, and it's all in all at pretty decent levels. But when you look at what's going on with natural gas, it's one of the few positive things we can talk about, is that we have seen a very positive, finally a positive shock to our economy, not a negative shock, a positive shock on the energy front. And that is what has happened to the natural gas prices and oil prices as well, because there's both wet gas and dry gas. We don't need to go into the details, but the point is that we have, in essence, become probably the low-cost energy producer in the world, with huge supplies that are available. So you can see how very recent this phenomenon was, because look what happened in 2008 to natural gas prices. They kind of followed oil prices up. But now that oil prices have skyrocketed back up following the recession, you can see that natural gas prices have not done that. They've stayed low. And they've stayed low because of a huge supply increase. Both a combination of hydraulic fracking and horizontal drilling. I know that New York State isn't allowing that to take place, but other states are. And it's being a real boom for activity, especially for those sectors that are highly dependent on energy. So for example, let me show you how much of a game-changing phenomena this is. So here I'm putting in the numerator, the price of natural gas. That's in millions of BTUs. In the denominator, barrel of oil, price of a barrel of oil. Now, it's apples and oranges, but I'm keeping the bushels constant, so it's a fair comparison. In essence, what it shows that between 1994 and 2005, we saw that the average ratio was about a 13% share. So in other words, natural gas prices in millions of BTUs were 13% of what they were for oil prices. But you can see what has transpired subsequent to that, in particular in the last few years. It has just moved lower and lower to the point that last year it was at 3%. What does that mean? Relative to what it was a few years ago, natural gas prices are 1/4 of what they had been compared to oil. So if you have the choice of running your production on oil versus natural gas, you're leaning towards natural gas, especially if this is a long-term cycle. And reports are that we have decades-long supply of natural gas. In other words, this is not we're going to pop a few wells in, we'll be good for 3 or 4 years, and then the game's over. Estimates are that there could be anywhere from 50-year supply of very inexpensive natural gas to as much as 200-year supply. Hard to imagine that. It's causing a lot of additional activity, especially in manufacturing, which I follow very closely, which is one of the highest energy-intensive sectors of the economy. In particular, chemical industry. 70% of their cost is energy-related, both as a feeder stock and as the energy needed to produce. So we're seeing chemical plants being built for the first time in 15 years. And I did a panel, moderated a panel with the energy buyer for Dow Chemical back in the springtime, and I threw up a little softball question to kick things off. I kind of knew the answer. I said, so when Dow was looking at putting one of these plants into a location, are they thinking where energy costs are going to be low for the next 5 years, 10 years? You know, he goes, Bill, these plants are designed to last 40, 50 years. So it's that horizon that we're looking at, where is the least expensive cost of energy going to be? And he said, without a doubt, it appears to be the United States. So we're seeing a lot of additional activity on the manufacturing front. We're also seeing a lot of improvements with regard to logistics. Probably here in Buffalo, you're finding a lot more of your intra-urban transportation being driven by natural gas powered vehicles. I know in Chicago, we in fact have natural gas operated taxi cabs that are now starting to appear. So this transition is definitely going to be very, very beneficial. Removing food and energy prices, we see that the inflation rate, that same phenomena, that disinflation, weakening of inflation happening on the core rate. What's the outlook? Well, again, if you thought that inflation, maybe it's low now, but just you wait, well, you want to look at things like the futures market. Those remain well anchored. And those are people who are putting dollars down. They're not just speculating with their mouths, they're actually making bets. And those remain well anchored. You look at forecasts like the blue chip, and I look at the last set of bars there. And if the view was low now, but just you wait, by the end of next year, you'll start to see it go higher. Well, then I would expect to see these green bars start to move higher. And the fourth quarter of next year is just as flat as any of the other quarters, coming in around 2%. The Fed view on the one that we tend to focus on, the personal consumption and expenditure deflator, which includes food and energy prices, our target is 2%. In fact, that's a relatively recent thing that we're announcing a target. It's expected to, over this forecast horizon, remain below that 2% range, approaching it, but not exceeding it. And then for the underlying rate of inflation, a very similar path. So with the slack in the economy slowly being worked out, we do not see tremendous inflationary pressure in the economy. Yes, sir?
Why isn't zero inflation rate a good thing?
That's a great question. In fact, during the policy debates, that when we were initially doing this, and by initial, we're going back to when Chairman Greenspan first came on board in the late 80s, August of '87, he joined the Fed. It was a discussion about what is the proper policy path for inflation in the country. And many people talked about price stability would mean that the price level should not rise. That's zero inflation. But that has lost a lot of favor, especially when you witness what economies like Japan have been dealing with, which is deflation. Deflation is a very challenging aspect for a central bank or any economy. That's when prices are falling. Now, prices going down can be good if they're driven by technological improvement, right? Computer prices continue to move lower, TVs and so forth, but you can have falling prices when it's technologically driven. But when they're driven by weak demand, that's not so good. And you're like, oh, I'd be happy paying less for what I have to buy. But just keep in mind, what that also means is that your employer is earning less on what they're selling. And if your wages are staying at that same relative position, you have just become a lot more expensive to your employer. So they're going to either have to go to you and say, I got to cut your wages in nominal terms to get them down to real change of zero, or I have to let you go. So it becomes some real problems. So because a zero price path would suggest that sometimes you're above, which means sometimes you need to be below, that sometimes being below was viewed as too risky for the economy. Because the real interest rate would basically, as deflation increased, the real interest rate increases. I should say, as the deflation rate goes lower and lower, or more and more negative, that becomes a higher and higher real interest rate, and that would kill your investment. So, with that in mind, all right, we got to pick a positive number. There was discussion of anywhere from 1% to 2%, and it seems like 2% seemed to win. And we're going back actually to what Chairman Greenspan once defined as a success on inflation. Those of you who I see, like me, are old enough to remember the high inflation periods, but they were also not just high, they were very volatile. So the view was that when inflation no longer comes into the decision-making process, where in other words, you can kind of say, okay, you know, I think we could all, how many people think inflation over the next year is going to be around 1% plus or minus a percent? So anywhere from 0 to 2%. Anybody think it's going to be much different than that? I don't see any hands in the room going up there. Maybe one person. The point is that that's a pretty certainty kind of outlook, and that people are able to make adjustments with that in mind. And that's what was one view of what we would consider success in terms of an inflation path. So let's close off by just talking about monetary policy, and then we'll open up for some additional questions. So the Fed's main policy tool, the federal funds rate, the overnight lending rate by banks, was driven down to 0, basically, 0 to 25 basis points at the end of 2008. So next month, we will now be at 5 years of 0 interest rates. But I could also tell you that those interest rates were too high. There is a rule out there, some of the students will know, and some of you remember, known as the Taylor Rule, named after economist John Taylor, who had this rule for Fed policy that suggested that during the deep downturn of the Great Recession, the Fed should have sent their interest rates down to a -4 to -5%. We hit the zero bound, what used to be called the liquidity trap. When demand was so slack relative to supply, the price drops to basically 0. Now, we thought about having negative interest rates in this country for about a nanosecond, and you'll think about it too. So what would that entail? It means that your bank, for every $100 that you have on deposit, next year, they'll give you back $96. Good deal? That's a -4% interest rate. What would you do? What's that?
Shoot myself.
And how long did it take you to conclude that, Linda?
2.5 seconds.
2.5 seconds. All right. So maybe you're not you UB grad? UB grad would have had it faster. No, just kidding. Sorry, I didn't mean to pick on you. But I'm very proud of our university here. But yeah, it doesn't take very long for people to realize there's a good alternative to deposits. It's called cash. And the bank runs that would have ensued, where people, yes, would have put in the mattresses, would have buried in their backyards, and all that money coming out of the financial sector just would have imploded that sector. We realized it would not have been a very good policy approach. Now, one can ask, why did Cyprus do what they did early in the year? No, they didn't talk to me, that's for sure. I could have told them that it would have caused the bank run on their deposit base. So we were restricted. We could not go below 0. So the point is that while you might think that's a really low interest rate, we wish it could have been lower. Now, and some people suggested that, oh, the Fed was out of bullets when we got down there. We don't have any more tools. We'll talk about that in just a second. So the question is, what is the outlook for the primary tool of the Fed, the federal funds rate? Well, keep in mind that this is based upon the Fed's forecast. And what's our forecast? Growth improves over the next 3 years, but not much more than 1% better than trends. The fact that inflation rates remain contained, remaining below 2% over the forecast horizon, and that labor markets only slowly improve, so that we have to wait 3 years for us to get back to a normal rate. Well, in light of that, it says that we see little reason to raise interest rates this year or next year. And then in 2015, we'll begin to increase interest rates. This is the midpoint of the FOMC cycle group, where they think about 1% by the end of 2015. And then an additional 1% going up to 2% by the end of 2016. Now, this is going to be an interesting thing to think about, because when we begin to increase interest rates, or even when they talk about tapering the quantitative easing, I'll talk about that in just a second, people talk about that as tightening. In fact, we're still speeding. We're speeding right now, right? We're doing much more than we should. And we're doing that because of the weakness of the economy. So as we begin to not speed, it's not like we're slamming on the brakes. All we're doing is taking our foot off the accelerator. So right now we're doing 100 miles an hour, worried about getting a speeding ticket. Inflation terms, that's the speeding ticket that the Fed would be risking. So as we begin to back off of our policies, all we're doing is taking our foot off that accelerator. So we'll be doing 90 miles an hour or 80 miles an hour. We're still speeding. We could still get a ticket, but hopefully it would cost us less. So the point is, what is neutral? Where should the Fed funds be? Well, our policymakers think around 3.5 to 4.5% is neutral. So the point is, even 3 years from now, that policy is still accommodative, just less so than it was. And again, that message is going to be very hard to get across. If you listen to Fed policy makers, presidents and governors, you'll hear them trying to get that point across. This change of what's going to happen is one of removing accommodation, but we are still accommodating, just doing it at a slower pace. So since we hit that zero bound, the question is, what other tools did we have available? Well, one of the things that we started to do was to alter our balance sheet, to do things kind of more, if you want to think about it, the old-fashioned way, trying to impact the money supply. So you look at our balance sheet back here, before the financial crisis, it was about $800 billion. And we've increased it quite a bit. Now, all of this non-blue shaded area, that was a policy that was done during the financial crisis, little to do with trying to impact the growth of the economy, much more to do with making sure the economy did not implode by supporting the financial sector. So when we began to witness the freezing up of different markets and concerns about whether or not the financial sector would all of a sudden collapse, we became operations that any good central bank should do, even before the Fed was created 100 years ago, was talked about, which is operating as a lender of last resort. That when everybody's panicking, it is incumbent of a central bank to be ready to lend freely and willingly, but at a price, to those who are in need. And with a proper haircut, we did that. And so we provided liquidity into these specific markets. Now you can see all of those non-blue colored areas are now all gone, suggesting that the financial sector does not need that support any longer and hasn't for a while. And in addition, the stress testing that we put the 19 largest institutions through back in 2009 has made us a much, 2.10, much stronger economy since then. And we probably have one of the strongest financial sectors in the world because of that. Now, the additional increases in blue, those were policies that were put in place to impact the performance of the U.S. economy, both in terms of growth as well as the inflation path for the economy. And what we dubbed internally our large-scale asset purchase program, LSAP, but what the market has dubbed QE, or quantitative easing. And so here is QE1, where we bought $1.25 trillion worth of mortgage-backed securities as a way of putting a floor on the housing market and as a way of trying to get values to start to move higher. And as we've seen, I would say all in all, that program has had some success and some impact. In addition, QE2 was that $600 billion government purchase, and then QE3, the $85 billion, both mortgage-backed securities as well as government securities, adding to our balance sheet. So our balance sheet is now over $3.5 trillion, more than 4 times what it had been. So people look at that, oh wow, the Fed has increased its holdings by more than 4-fold. Isn't that going to be inflationary? Well, you know, from Chicago now, where Milton Friedman taught for many years, and he famously would say that inflation always and everywhere is a monetary phenomenon. And that's important to remember, and we certainly remember this at the Fed. It's a monetary phenomena, not a monetary-based phenomena. You know, so yes, we've increased our monetary base, which is what our assets are here, by a tremendous amount. And people will say things like, you know, the Fed's printing money. First of all, it's not true. We don't print money, right? Who prints money in the United States? Sorry? The Treasury, right? Now, we buy it from them. In fact, has anybody seen the new $100 bill with the blue stripe on there and the shift-changing ink in the inkwell? If you don't, I got an example here that I'll show you. I want it back. If you haven't seen the new 100, it's kind of cool. We buy that from the Treasury, 12.5 cents a note. That's the printing cost.
Meeting your demand.
Sorry?
They're meeting your demand. You say, give me some money, they can't, they print it.
Correct, and we pay them 12.5 cents.
So both of you in collusion together.
Well, I mean by collusion, because I'm gonna have you in collusion in a second. I'll explain why. So people talk about the fact that the Fed is print. Well, we don't print money. What we do is we create money, and we create money by buying these financial instruments. So you know what we're buying are Treasury securities, mortgage-backed securities. So if you have a Treasury security, is that money? Absolutely not. Right? You cannot walk into your favorite restaurant and give them a treasury security to pay for that meal. Right? So it doesn't perform the transaction demand of money. Now, it's fairly liquid. You can go and you can cash it out fairly quickly and turn it into money, but it's not money. So what the Fed does is buy these financial instruments, but non-monetary instruments, and in exchange, give out money. That's how we increase the money supply. Now, I want a little exercise here. Literally exercise. Put your hands up, please. 1 hand, 2 hands up, whatever you want to do. Everybody? Now, you may put your hands down if you ever took out a mortgage, if you ever had a car loan, if you ever had a student loan, if you ever had a credit card loan. You've never had a loan in your life?
Not personally.
That's fine. One person in the room. He's the only one who I could say has not created money in our economy. Every one of you I could accuse of creating money. Who gave you the right? Right? But that's how our fractional banking system operates. Every time you make a loan, it adds to the money supply. And what's the problem right now? We talked about it at the very beginning. Loan creation isn't happening. It's not happening at the rate anybody would like it to see, all those excess reserves. So when you look at the fact that the money supply historically is a multiple factor off of the monetary base. Right now, it's nearly 4 times the size of our balance sheet. That's what you want to focus on. Now, I never had a chance of taking a class from Professor Friedman, although I did take some classes from the University of Chicago. By the time I got to Chicago in 1980, he had already retired. And had written that book, Free to Choose, and that whole television series. Many of you might remember. For those of you who have not seen Free to Choose, it's available on, I think, on YouTube and stuff. You should watch them. They're as relevant today as ever before. It's amazing because the issues that he talks about are the same issues we're dealing with today. In fact, there was another great interview that he did with Phil Donahue when he was marketing that book, which you could also find on Phil Donahue had a full hour with Professor Friedman, and it's just fascinating. He talked about automotive bankruptcies. Kind of rings true today, but of course back then they were talking about Chrysler and so forth. So sometimes what goes around comes around. Anyway, but I couldn't take a class from Professor Friedman, the Nobel Prize-winning economist, who had won his Nobel Prize for his work on studying the Great Depression, monetary policy during times of financial crisis. I was invited, along with one of my colleagues from the bank, to go to his 90th birthday party, held in November of 2002 at the University of Chicago. In fact, we have more people here than was actually at that party. It was in a very small theater at the university because it wasn't just your typical kicking candles. It was a typical University of Chicago event, which was an all-day lecture series honoring the life's work of Professor Friedman. Now, they had brought as the keynote speaker the one professor after Friedman had retired in the 1970s, who basically began to become his replacement, the leading expert on the Great Depression, financial markets in times of stress, monetary policy in these periods. And this Princeton University professor flew in from Washington, because he had just joined the Board of Governors as one of the 7 governors in the summer of 2002. And in what I believe is only his second speech that he had given, he presented about a half hour. You could find this on the Fed's website, federalreserve.gov. He presented his remarks, but famously at the end of his remarks, because what Professor Friedman had talked about was this. This was basically saying that Professor Friedman blamed the Fed for the Great Depression. We probably would have had a really bad recession, but the screw-ups by the Fed in the 1930s made the Great Depression much worse than it needed to be. Well, what's the professor talking about? We were increasing our monetary base, but the monetary base is not the money supply. It's only a part of the money supply. And given all the bank failures that were taking place, rather than having loan creation, there was loan destruction. And so the money supply collapsed. Those of you who have seen It's a Wonderful Life, great movie, great for the holidays. We're approaching that period. It'll be on TV, I'm sure. I love that scene where, Jimmy Stewart's trying to save his Bailey building and loan. When he gets a run on it, he gets contact, he's driving by, and he sees all the people congregating outside. He has to jump out of the cab to go deal with it. And of course, everybody's nervous and they start wanting to pull the money out. Why? We didn't have the FDIC back then. So it was first to get the money, got it. And of course, a bank doesn't hold 100% of the deposits. In fact, they hold very little of it. They lend it out. And that's what Jimmy Stewart had to explain to people, is that I don't have your money, Christine. I've lent it out to Linda or to Philip. And if you make me give you back all your money, I'm gonna have to call their loans. And they don't have the money to pay me back the money, so I'm gonna have to take their home from them and sell it. And could you sell your house tomorrow? Any of you, could you sell your house tomorrow? Absolutely. I could sell my house tomorrow. Now, you might not like the price you get for it. No, that's important though, don't laugh. But that's absolutely, everything can be sold. And what happens during a time of crisis is that there are very few buyers. And so the price drops. So I might only get 40 cents on the dollar selling that, but somebody might buy it for 40% of what it maybe is worth. And the bank will not have enough money to give out back to everybody. The bank fails. So he was able to convince everybody, just take enough to get you through, we'll be all right. And eventually at the end of the day, he has $2 left in the till, dances around, these two will get married and have babies tomorrow, and we'll have more money tomorrow. To me, that represented a real failure of the Fed. Because really what should have happened is George Bailey goes over there, sees the run, he goes into his office, picks up the phone, calls his local Federal Reserve branch, and says, I got a bank run, I've got assets that are great, people are paying on them, give me some money, I'll give you as collateral, 50 cents on the dollar, as collateral, I'll pay you back in a few weeks. Boom, truck shows up, plenty of money at the bank, everybody goes home happy. In fact, probably people are gonna, when they see that truck, go, oh, they can get money if they want. I'm gonna have in my mattress, that's dangerous. My house can burn down, I can get robbed, I'll leave it at the bank. So that to me illustrated, and it wouldn't have been a good movie though, right? That's not as exciting as what they have to do. But nonetheless, that's what happened. Banks failed, even healthy banks failed. Money supply contracted, what Friedman would refer to as the Great Contraction, not the Great Depression. But look what happened to inflation. Did inflation look at what the Fed was doing and say, oh, we're gonna go higher? Ooh. Inflation always and everywhere is a monetary phenomena, a money supply phenomena. The money supply went down, price level went down. We had deflation. So, the Princeton University professor comes there and at the very end says, you know, Professor Friedman, Milton, does anybody know who I'm talking about, by the way? Who was this Princeton University professor? Ben Bernanke. Says, you know, Milton, as a newly minted member of the Fed, I want to tell you on behalf of the Fed, with regards to the 1930s, yeah, you're right. That was our fault. But because of your work, we're not going to let it happen again. And I thought, isn't that cute? Telling a 90-year-old man that his life wasn't wasted, that we learned so much from him. But isn't it interesting the way there's this theory out there referred to as the great person theory, right? Having the right person at the right place, whether it's Winston Churchill or George Washington and Alexander Hamilton when they had to throw out our Articles of Confederation and put a constitution in place to save the country. How those things seem to work out. And that a few years later, Bernanke would leave the Fed to become head of the President's Council of Economic Advisors. And then when Chairman Greenspan was leaving his term of chairman after 19 years at the Fed, he was named to be the next chairman in January of 2006. And so now we had the world's leading expert on the Great Depression when we were less than 2 years away from witnessing a potential second depression. Say what you want about Bernanke, one thing you can say is that the man is not a liar. True to his word, the Fed did not let it happen again. And so we didn't take our balance sheet up slightly, we've taken it up a lot. Well, what has happened to the money supply? While the balance sheet has risen by over 20% a year since 2007, the money supply has risen by just 6.3%, something you want to think about more in line with nominal GDP, real plus the inflation path. But look at the inflation rate. Is it following the blue line? No, it's following the green line. In fact, with all the slack in the economy that still remains, it's not even tracking it all that closely. So I would put forth that had the Fed not done as much as we have done, we would not have the performance of the green line being as elevated as it is. It would have grown a lot more slowly. And I would put forth that the red line would not have been rising as slowly as it is. It would have been going down, growing a lot more slowly, or perhaps even having deflation. So that has been in large part of what we're doing. To conclude, the issue is, how do we get out of this? Large balance sheet. Well, we got assets, right? It's not like the money has disappeared. We've got these assets sitting on the Fed's books. We could either sell some of those assets. It's a lot of assets to try to sell at one time in the market. But we also have the ability of just letting them run off our balance sheet. The average age of our balance sheet is probably around 6 years of age. So in other words, if we don't buy anything further, in 6 years, the balance sheet goes to zero. So that can happen. The other thing that we can do is we don't have to sell any of those assets, or we could do a combination of all of them. We also have the ability of regulating the growth of M2, because what the issue would be that if banks all of a sudden woke up and said, we have all these excess reserves, let's lend them out, we can see the green line, the money supply, start to rise more aggressively. Now, quite frankly, I wouldn't have a problem with that. That would be a good challenge to have. I would be happy to see the money supply start to rise more rapidly. Why? Let's follow the path. Why would the money supply be rising more rapidly? Banks are lending a lot more. Why are banks lending a lot more? Business is better, confidence is better, consumers are borrowing, which would mean, rather than talking about a 3% economy, maybe you could get a 4, 5% economy. Now, would that suggest that the policy path that the Fed is operating under would hold under an alternative outlook, which is brighter? Probably not. We'll have to make adjustments. One of those adjustments we have is the ability of paying interest on excess reserves. If we perceive that the money supply is rising too rapidly, in other words, banks are lending more quickly than we would like, well, if they're offering a business to borrow at 7%, right now we're giving them 25 basis points on their deposits, we can increase that to maybe say 1% or 2%. Now, the risk for a guaranteed return versus the risk that they're taking to lend out has narrowed. They'll either have to tell that person, sorry, I'm going to have to charge you more, in which case maybe the business can't justify it, in which case the loan doesn't get made, or they just outright say, no, I'm willing to take a 2% guaranteed return, and they don't make those loans. So we have this throttle that we can try to, that we will, more likely employ to try to regulate the growth of that money supply, because ultimately, as I mentioned, inflation is tied to the growth of the money supply. So that pretty much, I got concluding things on there, which is basically growth is going to be, as I mentioned in the beginning, so-so, not bad. It's going to feel better, but again, not great. Sir.
What has changed now to prevent the mortgage lenders from taking such risky mortgages out back in '07, '08? What's changed so that can't happen?
Well, if anything, the problem we hear is the exact opposite. If you've talked to anybody who's applied for a mortgage, it's really far more complicated than it's ever been. And unfortunately, that's often the case. What happens when the regulations, when you try to regulate something after a disaster, it tends to make it far more difficult. So it's actually a lot more restrictive. And in fact, most of the activity, or a large share of the activity that we're seeing with regard to the real estate market, is actually on the cash side, the investor side. And that's part of the problem that we need to work out, is making it easier for qualified borrowers to borrow. Now, what kind of things did we not like to see happening at the end of the bubble? You were hearing things about people doing these ninja loans. You know about this ninja loans? No income, no job, no assets, and you still got a loan, And, we heard these stories, and we laughed about them like you laughed about them when we hear from our contacts about Ninja. But we thought it was, and this was our mistake, was that it was not as prevalent as it really was. Because I guess the failure was, who in their right mind would lend out to somebody that they knew couldn't pay it back? But of course they did that. Why? Because you could take that piece of paper, give it to somebody else. But who in their right mind would buy that piece of paper knowing it was given to somebody that couldn't pay it back? So it was actually a multiple set of chains of market failure. Of course, those type of loans now you don't hear about. You don't hear about the 105% loan-to-value mortgages. The requirements are actually now going back to more traditional, maybe even too restrictive, 20% down, and which is now going to take people a lot longer to accumulate those kind of assets. So I think that that market, and we do surveys on the senior loan officers, their willingness to, or are they loosening their standards? It is finally just beginning to loosen after basically remaining tight, after tightening for many years. It's just now beginning to loosen. So that hopefully will foster some increased activity in the housing market.
Yeah, but that, Frank, hasn't been fully rolled out yet. Can you be optimistic about the lending standards getting looser?
Ultimately, the businesses, the banks want to make money, so hopefully that will happen. And there are challenges. For example, we have these community banks in our district. In particular, we had an Iowa peer group come in earlier this year. And one of them said, Bill, to make a loan, it's like this thick in terms of the paperwork we have to do. In Iowa, homes are, $80,000, $90,000 you can get a house. He goes, I can make an auto loan for that amount, and the paperwork's like 3 pages. So clearly there has to be some balance, and in fact, the chairman recently gave a speech addressing that point, that we need to be sensitive to different markets, that one rule that applies across the wide spectrum of housing, you need to be thinking about.
Don't you think Dodd-Frank would be restrictive?
Dodd-Frank, well, yeah, I mean, it's so far, and in large part, the rulemaking is still taking place, and that's not helpful. We need to and the rules are being worked out, because it's the uncertainty as well that is causing banks to hold off. Because they don't want to, issue something that all of a sudden it turns out that it doesn't comply. And now they have to take it back on their books if they in fact sold it. So there's all kinds of issues that hopefully when they get, all the rulemaking finally gets worked out, will be less uncertainty and hopefully improve the markets there. But it's, clearly tougher to get a mortgage today than it was before the crisis, and probably too tough.
Just a quick question, was it Milton Friedman, YouTube, what it said?
Oh, it was Phil Donahue, and the other one was the Free to Choose series. Yeah, it was a book that he wrote back in the 70s after he left university, and they turned it into a PBS series. Yes, sir. So the question is, as the Fed goes through its programs of trying to maintain proper policy in light of a large balance sheet and the potential unwinding of that balance sheet, what will likely happen to interest rates? Would there be a big spike? So first of all, I can't comment on future direction of interest rates outside of the federal funds rate. But clearly, the interest rates are related to the federal funds rate. And the interest rates, as we normalize the federal funds rate, we'll probably need to make adjustments higher. How much higher? That I can't comment. Yes, sir.
I thought the FHA was still either offering or buying loans at a very low percentage down, like 2% or 3% or something.
So there are certain markets, but that's not, still all in all, not a lot of people qualify for the FHA type of programs. Yes, you are hearing activity in that particular market, and yes, it's still relatively low deposit, but they have lots of limits in terms of the type of homes that qualify under that. So again, when you still look at the market, it's still not having all that much of an impact. Yes?
Yeah, at times during the contentious debate over expanding the national debt ceiling, I'm thinking more about a year and a half ago, you would hear talk about the $1 trillion coin. Does the Fed have any feeling on that? And I guess sort of related to that, there's no mention about Bitcoins. Is that starting to surface on your level?
So it's the $1 trillion coin. I mean, that was kind of a thing that they were, the Congress and the Treasury. So that's the fiscal side. I really don't want to get into. And we don't really tend to make comments about the fiscal side, and just as we don't want them to make comments about the monetary side. But I don't know whether the $1 trillion coin, would have accomplished what they wanted to accomplish. $1 trillion is $1 trillion, whether you have a coin or a dollar. I don't know. With regard to Bitcoins, it's a market that we're certainly paying some attention to. We've got some people who are studying it. In fact, we have a payments group within the Chicago Fed that are looking into it. It's kind of an interesting concept. So Bitcoins are these coins that are being, or basically currency that's being issued out there by a non-governmental organization. And of course, if you pull out your piece of currency, on the face of that currency, it has a statement on there that said, this currency is good for all transactions, both public and private, and so forth. That's what gives currency its value, right? In the United States, the fact that the government has stated it has value? Absolutely not. Right? You could put that same statement on a Zimbabwe dollar, right? I actually, a couple of years ago, I became a multi-trillionaire. I have a $100 trillion note from Zimbabwe. A stack of them might buy you a loaf of bread. So what gives a currency its value is the people's willingness to accept it for goods and services, not what's written on it. And so again, that's what we think about when we think about Fed policy. So the question is Bitcoins. Right now people have desire for it. And what happens if all of a sudden there becomes some discussion about, well, is this really accepted? So it's still an infant industry, and too early to say, whether it has any kind of lasting traction. Yes.
Talking about currencies and for people like us who do not study very deeply, there is always this paradox that why would someone, after all currency is bartering, instead of barter you take currency as an IOU,
Right.
why would somebody, because we have currency differential in China, will they be willing to trade 20 hours of same work with somebody who does the same work for 1 hour? In the sense, they work 20 hours, make a piece of product, and with 1 hour's work here, I can buy that. Why is that happening, and why is that not evening it out? Something is evening it out, like the commodity market.
Right. And you said you didn't study economics?
I did.
Okay, no, that's a very well-worded question. No, it's absolutely right. Yeah, the question is basically, why do we have situations where you have somebody doing something, spending an hour working here and making $20 an hour, somebody working in China making just $1 an hour? And
Same work.
so that's becomes a question, whether or not it really is the same work, because the question is, do they have the same training? So normally it would be a situation where those kind of things should not happen, where you're actually getting the same work for 1/20th the price, because otherwise you would see the big sucking sound and everything leave. Now, in fact, if that was the issue for manufacturing, we heard about all this outsourcing that was taking place. Well, if it was really a wage differential, you would think that the industries that would be the most damaged, the most at risk, are the ones that have the highest wage differential. But that's not what happened at all. The ones that actually got more impacted were actually the lowest wages, textiles, apparel, where those workers were making $10 to $12 an hour. That's the kind of work that got shifted over. Why? Because it was a matter of low wage, low skill. That's the kind of workers that we're competing with in these developing economies. Now, over the period now, we're going back now over 10 years, wage inflation has been very significant in China. And so the cost differentials have narrowed markedly. And in fact, you talk to businesses today, the China strategy is often not viewed as a very great strategy. In fact, the Boston Consulting Group earlier this spring came out with a study where their estimates are that the cost differential between the United States and its European counterparts, as well as Japan, are going to be significantly lower here by a factor of 10% or more. Italy, 23% cost differential, lower in the United States. Once you factor in labor adjusted with productivity, energy cost, materials and everything. China, they're lower than us, but by only 4%. So we're at 100, they're at 96. Once you start factoring in now logistics, currency concerns, as you may have suggested, issues about supply chain management, it begins to be not as good of a value proposition. I think that concept of globalization was overblown. In fact, I testified about this to the U.S. Senate back in 2010, that all in all, I'm very optimistic about U.S. manufacturing and have been, because it's localization. Some manufacturers will talk about regionalization. So you'll put something in the U.S. or Mexico to supply the Americas with production. This view that you could have one location to supply the world, that view is no longer thought of as the best model, especially when you think about what happened in Japan following the earthquake, tsunami, nuclear disaster, which wound up causing shortages of production that only was available. You heard about the different color paints and everything that was coming out of that one factory. Well, when you didn't have that factory, you were impacted. So that suggested being closer to your customer, which is going to benefit the U.S. tremendously. So let me put one more thing into perspective, because we talked about growth rates of labor forces. So the largest economies in the world in terms of population is China, India, and then the United States, right? We're the third most populous country in the world. What's China's, and by the way, China's growth rate, 7.5%, they're catching up to the US very quickly, because we're only growing at 2% or 3%. So at some point, they will, and probably in many of your most of you in your lifetime, they might actually become a larger economy than the United States. But that's not what you should be thinking about, because you want to think about it on a per capita basis. And on a per capita basis, keep in mind that they have 4 to 5 times our population. So when they equal our income, what does that mean on a per capita basis? That they are still 4 to 5 times poorer on average than the United States. That will not change in anybody's lifetime here. The growth paths are just too close to have them all of a sudden, because in fact on a per capita basis, we're at $47,000 per capita GDP. They're at less than $10,000 per capita GDP. But after the United States, who's the 4th most populous country in the world? Sorry? Not Germany. Not Japan. Indonesia. 250 million people. Again, another relatively poor country. So there is no country out there that has that income level and that base of a market. That's why we're looked at as such an attractive place to produce and to sell goods. Yes, sir.
I don't know if this question is germane for here, okay? You have to understand, if all the people in the room here know absolutely nothing about economics, I know less. Okay, but
Hopefully you learned something.
Right, well, no, but the thing is, I've had a fascination with gold for years, and I've been in the hobby of gold. I'm just wondering what your opinion is investing in bullion gold. I do a lot of investment gold too. But the idea is like I've heard like China is trying to buy up most of the gold in the world, so that their currency is then going to be the currency of the world because they're going to back their gold. So there's reason. I mean, I have it as a hobby.
Yeah, all right. I appreciate it. So I'm not going to give you advice on how to invest and what you should do. I've heard a lot of people talk about gold. Gold is often looked at as one of those types of products when the world is very nervous and concerned. People flock to that. We are, of course, we went off the gold standard here in the United States for our currency. Back in 1933, during the Great Depression, international settlements, we went off of that in 1971, well actually 73, when we allowed the dollar to float, no longer pegging it to a fixed exchange regime again with gold. That being said, you think of gold as a financial asset, but again, it's not money. Ron Paul used to challenge the chairman when he would testify about gold, asking him, is gold money? And the chairman would constantly respond, no, it's not. And then, well, it's been money for millennium. Well, that's great. Go into, Anchor Bar over here and order yourselves, a set of wings and a beer, and give them, a piece of gold and see if they're going to take that as settlement. It does not have that transaction demand. That transaction aspect to it. So it's not money. Money needs to fulfill 3 things: transaction, store of value, and a numeraire against other goods. So it fulfills many of those: store of value and numeraire, but it's not used for transactions. Could that change? Sure, but I don't see that in our future here. And with regard to is China buying it up? In fact, what we've seen, in fact, is that as the inflation path has weakened, because gold is usually looked at as an inflation, hedge, so has the price of gold. Keep in mind that gold as an asset does not return anything in terms of interest, right? So, that's something else that you need to think about. In fact, I had a chart that I used to show back when people were really getting excited about gold a few years ago, when gold prices were moving up to $1,900 an ounce, which showed taking in, $10,000 invested in gold in 1980 versus putting it in the S&P 500 index. It's not even close in terms of what kind of recovery you would have been, multiple times better. I'd be happy to send you that chart if you. Sure.
Yeah, and you can dismiss this if you want, okay. I just want to use a Freakonomics thing. I never understood, did you notice in the last year or two that platinum was going for less than gold by about $100 an ounce? Okay, understanding, okay, if you melted all the gold in the world that's been mined, you'll fill 2 Olympic-sized swimming pools. You melted all the platinum in the world, okay, you wouldn't fill a one-car garage. So there's a lot less platinum. There's no manufacturing value for gold other than, but platinum, you need $140 for every car out there, plus the platinum only comes from Russia, essentially, and from Africa, which are unstable governments. Why was it $100?
That's a great question. I can't answer it. I mean, it's all a matter of supply and demand. I do not have a great answer of why platinum's prices have moved the way they move versus gold prices. Yes. One or two more questions, then Wendy's got some closing remarks.
Going out a little bit, a few years you saw that GDP was falling a bit.
Sorry?
Going out a few years you saw GDP dipping a little bit.
The growth rate dipping, right.
Do you see an impact of a demographic drag on that, or is that not significant?
That could be part of it too. And somebody brought up about the labor force participation rate. Was it you as well? So you got the labor force participation rate that has fallen, and in fact we're now at levels that we haven't seen in 35 years for participation rates. Keep in mind though that labor force participation rates have not been falling since the Great Recession. They've been falling since the year 2000. Why? We're an aging workforce. So as people, it's right now below 63%. 62.8 is the most recent reading. But if you looked at the 45 to 55, it's well over 80% participation rate. But it's those cohorts that are a little bit older. And by the way, that has been rising too. But the fastest growing decennial group in our country is what? Sorry? Over 100 is right. You're the first person to get that one right. Yes, people over 100 is the fastest growing decennial group in our country. So, may all of you live to be 120. But you had one more point about
Just if there was an impact
on growth. So, ultimately, you want to think about what kind of a purchasing pattern does an older economy have versus a younger economy. And this is where we get into this whole issue about, is a CPI adjustment to Social Security or Medicare, is that a proper adjustment? In fact, the CPI has been kept low in part because of a lot of technological improvements on electronic equipment. But if grandma is buying a lot of pharmaceuticals, those have risen a lot more. So there's talk actually of trying to come up with, and they actually have some of these CPIs that are more, market baskets by age cohort. And that would probably be a better way of adjusting some of these cost of living factors. One more question was there? It's going to probably continue to move lower. So I should have finished up. So it has come down, but it's still, our estimates at the Chicago Fed is probably now in excess of 1% below where it should be. So we could see some improvement as labor market conditions improve, and we're expecting those labor market conditions to improve. So one could either think that it could bounce back up or at least stop falling and just let it kind of catch up with its long-run trend. But it's probably a lot lower, and that is in part to discourage worker phenomena, and people, maybe working part-time, part-time would be included in the participation, but hopefully we'll see a lot more activity in that group. So thank you very much.
Oh, Bill, don't run away, please. Thank you for what was a very interesting and comprehensive overview of the economy. We really appreciate that.
Thank you,
We
Wendy.
thank you for your time. We thank you for joining us this morning. Please know that we're proud to have you as a UB alum,
Thank you.
and we're grateful for all that you do for UB. And thank you very much.
I promise I'm not going to hold you much longer. Allow me, for those I haven't met, allow me to introduce myself. I'm Wendy Irving. I serve as Assistant Vice President for Gift Planning at the University of Buffalo. I, along with my colleagues in the College of Arts and Sciences, are grateful that you joined us here today, and hopefully you leave as enlightened as I did. Your students are lucky to have you. You're a good presenter. I learned a lot, so thank you for that. As most of you are aware, these are exciting times at the University of Buffalo and for this region as a whole. Not far from here, right around the corner, we're breaking ground on a brand new medical school. Our College of Arts and Sciences is celebrating its centennial, and the UB football team is red hot. Isn't that great? It really is. It's likely that we'll be play a bowl game this winter, and we're betting that a number of our players will be NFL bound in the spring. So please, we welcome your continued support in that regard. We've got great momentum, but please know that we welcome your involvement so that we can continue this. You can have an impact at UB, and as such, have an impact on this region. You may be receiving a call from one of my colleagues in the weeks and months ahead, and I ask that you please be open to sitting down and having discussions with us in terms of your involvement and engagement with the University of Buffalo. Finally, I hope you've enjoyed this presentation as much as I have. We'd like to continue to have such programs in the future. Inside your evaluation package, there is a charge for attending today. Please complete your evaluation form, share it with us, share any ideas that you might have so that we may continue these type of programs. Thank you for involvement, and please take care and travel to your offices safely.